I'm Keith McCullough, and welcome to my coaching session. All right, we're going to have a little bit of fun, I hope. But it's going to mix it up a little bit in terms of what I generally go through and slow it down just to get you going here. It's not going to be like a macro show. We will get into some macro themes, applying the process, obviously, to some conclusions. But first, I'm going to start with, again, sizing and timing, okay? Sizing of a portfolio and timing, how to construct that portfolio, or at least how I do, and really starting to think about your process in a deliberate way that you can be disciplined and, again, execute on that process. So let's just jump into sizing at the very basic level. Okay, I walked through this at Hedgeye Regional, and I don't think you can walk through it enough times. It's just like walking through anything in terms of pregame preparation. So this idea of portfolio sizing, I'm going to show you two examples of two typical portfolios that I would run. A long only and a long short book, okay? Long only, these are the max positions by size, foreign currency. US dollar position, for example, my max position would be 12% in this portfolio. Fixed income, you can take anything that I have currently, something like T-bill, for example, 10% position there. Equities, so the beloved SPY monkey, if I had that, that would be 6. I don't have that, but I have something like, let's go with EWJ, Japan, okay? I don't know why people are so biased, but I do on that old SPY monkey. That'd be 6%. Something like uranium, which we're currently long, commodities, 4%. And then my options book will be 1 to 2% of total capital at risk. So again, decide before you start talking about timing and all these fancy things that you might think about fundamentally or not. We're going to get into that as well. Fading the fundamental and understanding the flow has a lot to do with the timing before you even get there. Before you even get there, you have to, in kind of the old hockey head speak, you have to put your skates on. You got to put your jersey on. You got to put your helmet on. You have to decide what is my minimum size in terms of positioning, what is my maximum size. So again, in as much as it's important to say, okay, 6% is my max, what's my minimum position? Okay, so here I'd have a minimum position of 2%. All right. Now let's apply this to and again, have a min-max for every single thing that you could potentially execute on before you do anything, okay? And if you haven't done this before, you better, and you better get better, or somebody who's doing that is going to do better than you over time. Then you might do better for a day trade. I know like some of you like these 0 days to expiration. You may do better for a week or a month. You might do better just coming out of a pandemic for 3 months. But you are not going to do better over the course of the full investing cycle life where you're tasked, again, with preserving and protecting your hard-earned capital and then compounding returns, okay? Now, if you want to do that and hedge, that's what some people just, they call it a hedge fund, but they don't hedge. They just use leverage. That's not what I do. So again, if we're using a long-short book, rule number 1 in terms of portfolio construction, set my min and my max. Rule number 2, shorts are smaller than longs. Okay, so if we're currently short SPY monkey actually. SPY at my max position, which was August 1st, would be 3%. Now take that position down closer to 1% after a drop like we had late last week. It's okay, you can do it. And move that inventory actively. You shouldn't really care what's on the short side. You shouldn't have any feelings. It's not a marital relationship. It's certainly nothing that you need consent on. This is just 3, 2, 1. My max is 3. My minimum's 1. My max on long, whether it's, again, if I'm looking at an equity position in particular, it's going to be 6. My max on a commodity still in this portfolio setup could be 4. But again, what's my minimum? 2. So when I sell down my Japan after a good move or my India long position, it goes down to 2. It doesn't go to a half or it doesn't go to 0. It's not all or none. Everything from a sizing perspective is a min, a max, and how we interact with that portfolio incrementally, okay? Incrementally, what does incrementally mean? Let's just say that you like to take 50 basis points at a time. 50 basis points, if you were to go to your minimum position of 2% and you add 50 basis points, what do you have? You have 2.5%. Now let's be honest. How many of you thought about your portfolio in terms of basis points of capital at risk before I said that? How many people would say, oh, today, I sold 150 basis points of gross long exposure? That would mean somewhere in the portfolio, on a net basis, that's how much less long you are. I need you to get there. That's how we think about risk. If you're like, well, I lost $2 today because I run $100, so I lost, $2. I mean, that doesn't mean anything. Some of the worst traders I've ever seen, portfolio managers that became portfolio managers and then eviscerated themselves, they think in terms of like share lots, bucks, like $1 million on Wall Street, they call it a buck. It's not going to work over time. Certainly not across cycles. Okay, so portfolio sizing, I think we're clear on that. Now we're going to get into timing. Okay, timing is critical. Now, if we look at really the foundation of Hedgeye is it started on a lot of different things: transparency, accountability, and trust, of course, from a principal perspective. But our principal orientation. So when we think about, why are we going to show the world a better way? Well, the world's changed dramatically versus the world that I came from. So if you look at slide 4, this is the investment landscape showing you hedge fund assets under management. My former self, I started in this business, 3 or 4 years before that chart starts, on the buy side at a hedge fund as an analyst in the year 2000. Now that's when we were pretty big time, right? A lot of stock picking going on. There weren't any ETFs to compete with. There was no flow to really concern ourselves with. Now you can see, as Paul Harvey would say, the rest of the story, right? Now, the fine print that I rarely highlight, because this is a coaching session, but I want to make sure that you know what I know just to start, because beyond that, I don't know anything. But I got to get you to the base layer before we can at least try to get to the top of this mountain. Now, you can see at the bottom, systematic trading accounts for about 90% of total U.S. stock market trading volume. Like, are you ready? Are you equipped for this regime? It doesn't trade on, 90% of the volume doesn't trade on what the PE is or what some dope at CNBC says the multiple should be. No. That might be old wall ways, like slide rulers, pre-internet type stuff, but you're not like that, right? You're not going to be that way. You want to evolve, just like everything else in your life. You can't love AI and not evolve in terms of your market positioning, right? So here we are, no matter where you go. We're going to pay a lot of attention and give a lot of respect to the flow. Next slide. Now, nothing here has changed, okay? When we think about the process, we think about math, behavioral overlays. This is where I'm going to really get into it with the Tier 1 alpha data, because it's really behavioral when you think about flow. Time series history, of course, we use fractal math. We don't use simple moving averages or moving monkeys, all right? And what we want to do, ideally, if you could sell here and buy here all the time, you would, but you can't, because you're not willing to be Bernie Madoff and be perfect. But you can understand that tops are processes, November of 2021, and so are bottoms. Is the bottom in? Who knows if the bottom is in, and who cares? Well, I guess everybody cares every single day because they want somebody else to be perfect for them because they can't be. But this is a lot of work. But I can guarantee you over time, if you stay with this, and then you stay with this, you're going to do better than everybody else over time. Your drawdowns will be less. You might not even have a consequential drawdown. I rarely have a real drawdown, like 10, 20, 30, 40% of my capital. No. I'm not here for that. And if you don't like that, then you don't like risk management, and we're probably not for you. But if you are, and you're trying to take that hard-earned capital and you're trying to compound it, then let's try to get the full investing cycle right, from the peak all the way down into the recession and back again. All right? So something to think about there, because that's the principal stance that we take. It's all rate of change driven. And now let's jump ahead to some signals that might give us an idea where you are on that sine curve from an economic cycle perspective, okay? Because there I was talking about the economic cycle, of course, which we'll get back to when we get into this thing. But let's just look at slide 9. So we've gone from sizing to timing. Now I have 3 explicit durations that I care about: trades, trends, and tails. Trades are immediate term, 3 weeks or less, see that? Trends are 3 months or more, and longer term situations are pretty much inside of what a typical cycle. It won't be more than 3 years. So we use these durations for a reason. So it's called multi-duration. You have multiple durations. You're not just sitting there looking at a 50-day moving monkey. That's silly, all right? I could use other words than silly, and I have. Point number 2, we're multi-factor. So the signal, again, as opposed to using a simple moving average of things, which is nonsense, unless you're looking at it for behavioral purposes at the zoo, you would be looking at something on a multi-factor basis as well. So we look at price, volume, and volatility all inside of one fractal signal that, again, opines. That's why I say Floki's the one who's signaling this, not me, and it's smart. We've been using AI for a long, long time. So again, if something goes from bullish trade to bearish trade, like NVIDIA just did, then that's bad. If something goes from bullish trade and trend to bearish trade and trend, like Apple just did, that's bad. Okay? So again, you want to acknowledge that over time and over a better percentage of time, that when these things flip, or when you go from a bullish trend to a bearish trend, that's called a bearish phase transition. Phase transitions in all aspects of human life can be very good or very bad, but you would prefer to acknowledge if they are bullish or bearish indeed. Now, we overlay this obviously with factor exposures. So again, next slide, the positioning of the options market. So when I talk about behavioral, a lot of different observations need to be made before we can make a good decision. This is, again, this gets loaded into my machines every night. After dinner, I look at it. So again, whether I'm looking at the factor exposures, what's done well, what's not done well. On this current basis here, just coaching it up, on a 1 month basis, this is as of, I think, last night, Gendra, the really bad places to have your money were in really bad places. Small caps, again, -7. On a 1 month basis, you could have just lost right around 8% of your capital in these three things. Now, it just turns out that the Russell 2000 also went down 8%. We've been short the Russell 2000. Let's go back to slide 5. Okay? Let's go back to slide 5, Jen. I don't know if I can go back to it, and can I get the color on this one more time? Look at this. Now, if we go back to this, now the Russell 2000, 2442, was in November of 21. Currently, let's just say that it's here, minus 25%, 25% from its cycle peak. Okay? So we didn't own the Russell 2000 for this whole move. We were long it here. We were long a lot of things in 2001, but we're not long it for this entire move. Now, what you might say, oh, it's X off the bottom because holy moly, mixing totally. Just stop it. What they're really saying is that they missed this entire move, but we have these bounces, and this most recent bounce off one of these lows or whatever they're citing doesn't mean that this isn't going to happen down in here. And by the way, you don't have to go to new lows. You could, you should, but you don't have to stay with the process. Okay? So back to the slide that I was coloring up on factor exposures, that small cap as a factor exposure is down about 8%. If you use the Russell 2000, it was just down 8% from August the 1st. So what is going down 8% in 6 weeks? You generally won't hear anybody brag about that, right? So again, market cap, the bottom 25% of the S&P 500. We're looking at the top quartile versus the bottom quartile. That's how to read these. That one's down 7.5%, but that's the S&P 500 looking at the smaller caps inside of that relative to the large mega caps. Now, you need to know that. The machine knows that. To understand where the machine's going to go and where people are going to chase, which is, of course, right here, you can see, obviously, now that oil's been up 35% off its most recent quad 4 cycle low or disinflation cycle low. This is now being chased. Officially, it's a 1-year Z-score approaching 2. Anything greater than 2 on a minus or on a plus base, like if this is greater than 2 plus 2, or if it's minus 2, that should catch your attention. Why? Because it back tests as a behavioral thing that could correct, but again, not 100% of the time. It's just a level of macro awareness. So again, what have we reviewed so far? I know what my portfolio is going to look like in terms of min and max. I know how I'm going to touch my portfolio incrementally intraday. I know that I put my jersey on before I go out there, or I'm going to get made fun of. I know not to use moving monkeys unless for observational purposes. I know to look at factor exposures, sector styles, and options positioning. Still haven't made a decision. I just know this. It's called pregame preparation. If it sounds like a lot of work, it is. Do you know anybody else who plays at the highest level other than on Twitter trading stocks that plays at the highest level all the time with no real name? At any other high-level professional sport that you get highly paid? Absolutely not, right? It's Fantasy Island. What we're trying to do is teach you how to play the game for real and level you up.